Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking equities, those E-mini S&Ps. Reversing a bit of a downtick we saw, which began last week. We got down, made some lows last Friday. Saw our lowest settlement since February 14th, Valentine's Day, and we've kind of just started to creep back higher. It hasn't been a straight shoot. It's been a slow trend back, but we're back inside sort of that neutral area. No longer are we fearing a big sell-off, and we're certainly, while we're close to the all-time highs, we're not threatening to get back up there anytime soon either. And I think right now the market's just going to kind of tread water, waiting for the next event that's going to push us, whether we're going to make new highs or whether we're going to test the recent lows. And volatility, which did see a major spike last week, we got up as high as we have all year, with the idea that there were some issues over the weekend with North Korea, geopolitical risks in the Middle East as well. It looked to be that there was going to be a sustained period of equity sell-off, and that's really what drove the fear. While you had the events surrounding the market pushing us lower, it was really the fear that we were going to see a big move in equities, which we haven't seen in quite some time. Those fears have subsided. Volatility, the VIX index remains elevated, but is certainly out of the red zone and probably is trending lower. And I anticipate, as long as earnings continue to go the way they are, and as long as the data continues to go the way it is, there really isn't any reason for volatility to be bid in equities until we get to that next event. And looking ahead, we're going to continue to look for earnings. Visa earnings come out tomorrow. We've got a few others. Verizon. They're going to kind of set the table. But ultimately, equities have continued to lead the market. And when I say that, I mean they lead the market in a macro way. Whether it's bonds, whether it's commodities, whether it's currencies, whether it's emerging markets. U.S. equities have been really the driver, and you watch when equities rally, you see flight to quality bids in bonds and gold, and when equities sell off, when equities rally, you see the latter. So I think right now the key that equities are waiting for, it's no longer about Fed rate hikes, and it's no longer really about earnings and data. It is about data. It's about GDP. First quarter GDP comes out next Friday. There have been in ranges of estimates between, as high as 2.5%, 3% a few months ago to as low as below 1% now. And I think that right now equities want to see some growth. Yes, the earnings are important. Yes, we want to see continued positive earnings beating the estimates. But ultimately, we need to see growth here in order to see revenues continue. And that is going to be difficult, I think, if you see sub 1% growth. The Federal Reserve is going to pull back on some of the rate hikes, which will sort of ironically keep stocks higher and ultimately keep us on the trend. But equities really here, the big fear is a move lower, and that's why you're seeing some of the bids in some of the other asset classes, whether it be gold or bonds, because while equities are still driving the market, there is that underlying notion is when is it going to end? And right now it doesn't look like it's going to end anytime soon, but next Friday's GDP number could be the test of all tests for equities. Right. This has been Todd Colvin coming to you from the floor of the CME Group.